Welcome to Module 4, Risky Business, the Dark Side of Crypto. In order to approach the entire topic in an even-handed way, we also have to acknowledge many of the risks associated with this novel technology. After all, it's only existed for roughly 17 years with this inception of Bitcoin, and we're still very early when we look at other adoption curves, where we are in this technology and its diffusion. Again, each module starts off with the Florida Standards connection showing the multiple Florida academic standards and benchmarks that are met. Crypto can be quite a roller coaster, as you see in this particular graphic. It's full of big wins, major highs, but also massive risks and a lot of losses. So we need to explore the wild side of the digital asset technology. The word that's probably the most essential one to remember here is volatility. What and why? Volatility means that prices of cryptocurrencies can rise or fall very quickly in a short period of time. This happens because the market is still quite young and is very unregulated, although we're working toward that right now. Supply and demand shifts quickly, and it's influenced by news, posts on social media, and global events. Low liquidity can also amplify these changes to where we see these massive swings in price. One of the original propositions back in the 2017 cycle was what are known as ICOs, or initial coin offerings. These ran quite rampant back then. They do still happen now, but they're not as frequent as they used to be. An ICO is like an IPO, an initial public offering, in traditional equities, although ICO stands for initial coin offering. It's a fundraising method for blockchain projects where investors buy the future tokens in exchange for Bitcoin, Ethereum, or more commonly now, stablecoins, which are pegged to the US dollar and don't experience any sort of volatility. ICOs promise very high returns and democratized access for investors. It's similar to crowdfunding, but with using tokens instead of shares. The dark side of ICOs is that people could be selling anything, really. A term that's quite common in the digital asset industry is vaporware. This idea that people are selling empty promises and the technology really isn't there. This is allowed to happen because of the lack of regulation that exists in the space, because there's little investor protections. Scams and fraud can be rampant with exit scams, fake teams, phishing. You also have high failure rates. Projects that launch early on with a lot of hype, but then die out after a few months because token has gone down in value and people have lost interest. Again, market volatility is always going to be a challenge where you have extreme price swings and low liquidity. And then you also have manipulation risks where you have insider trading, pump and dump schemes where people are luring others in with the false pretense of gains. We also talked about NFTs, or non-fungible tokens. This is a unique digital asset, meaning that it is not fungible. Fungible is something that can be exchanged one for one. If I have $1 and I have another dollar, those $2 are the same. The same could be said for a Bitcoin or an Ether token. They are fungible, meaning the value is the same regardless of the token. In a non-fungible token, usually these are unique individual tokens that can be works of art, pieces of music, or any other type of asset that lives on a blockchain. So for NFTs, there are many kinds of uses, but there's also risks. Beyond the speculative uses of digital art and collectibles or gaming, we talked about Fortnite skins in previous modules. It could also be for things like event tickets or memberships or commemorative for going to a particular event. You also have proof of ownership because you are the one who owns that digital asset. It lives in your wallet on the blockchain. There are also a lot of other emerging use cases for non-fungible tokens or NFTs, such as medical records or voting. There's going to be a proliferation of NFTs as this particular technology continues to diffuse across different blockchains. The risks, of course, especially in the more speculative domains, may be that it suffers from market hype and speculation. You could have the same price volatility. A very famous example is a non-fungible token or NFT project called Bored Ape Yacht Club. And those tokens went as high as some sold for millions of dollars, and the average price for one now is about 12,000. So you can see the wide swings that happen for prices when you reach speculative manias. You also have scams and frauds. Sometimes they're just fake projects where people are lured in to mint their new NFTs, and then the developer who created the project just simply takes the funds and runs and never does anything, which is known as a rug pull. And sometimes you have environmental concerns, but these have largely abated because most blockchains now are proof of stake networks, and those are much more energy efficient compared to proof of work networks such as Bitcoin. This might be a good time to stop and have a debate with students. If your NFTs became all the rage about 5 or 6 years ago, and even as a former educator myself, I was deeply encouraged by this kind of technology because I believed that artists would have a way to sell their goods and talent directly to the consumer. But because of the speculative nature of some of these things and the value that they took on, people talked about it as if it was a bubble. So this might be a good activity to separate students and just talk about, and especially your more artistic students, maybe some of them have already dabbled with NFTs. Is this something that is a net good for artists or musicians, or is it something that's only going to lead to speculation? So it's a good conversation could be had. Decentralized finance is the removal of intermediaries for financial services. So DeFi, as we've talked about in previous modules, is just the shorthand for decentralized finance. It's built on blockchain. There are no banks. There are no intermediaries. It uses smart contracts or these platforms like Ethereum, Solana, and many other smart contract blockchains. They have lending, borrowing, trading, earning interest, and it's a great way because the rates are often higher without having those intermediaries in the way. Now, the pros and cons of DeFi, of course, some of the good things are that anyone with the internet can use it. There's 1.4 billion people on the planet who are unbanked, and many of them use crypto as their main savings methods. You also have transparency. Transactions are public, something that we've talked about in previous modules. You have innovation, new financial products. There are many new, what are called neobanks, which means new itself, that have emerged in the crypto space in the last year or so. And then you have ultimate control and financial sovereignty because you, as the user, control your own funds. The risks, however, could be some of the things that we talked about on other smart contract platforms. You could have bugs, you could have hacks. There's no government protection or insurance like the FDIC with a typical bank where you put money in and you're insured where your deposits are guaranteed to come back to you. Market volatility can affect your returns. And then, of course, this can be quite complex for beginners. And as we noted, we have outright scams or rug pulls. This is when fake coins or projects can just disappear overnight. And here's a really famous example from 2021. The Squid Game, which had become incredibly popular thanks to the Netflix series, had its own token. It was inspired by the show, and the Squid token promised a play-to-earn game. And gaming was very big 5 years ago in 2021. So the price soared over 400x in a matter of weeks. This is astonishing returns compared to traditional markets. So investors, however, couldn't sell. They could buy into the token, but they couldn't sell the token and realize those gains. So as more people saw the price chart, they wanted to just jump in and try and earn money, but in so doing, their funds were locked. Eventually, the developers just drained all the liquidity from the smart contract and the value collapsed to zero. And the scammers got away with well over $3 million. Hacks and theft continue to be an issue throughout the blockchain industry. This is just a bar graph over time showing billions lost in exchange hacks alone. Some of them going back many years to some as recent as the Bybit hack that claimed, over $1.5 billion of ETH. And then, of course, you simply have fraud and phishing. Things that existed in Web 2 are no different in Web 3. We have various types of scam categories, but we don't need to read through them all. You can see many of them, and many of them are going to be familiar for people who have been on Web 2 for many years. Even if you've never interacted with crypto, some of these kinds of scams are quite similar and have been ongoing since effectively the birth of the internet. FOMO is shorthand for fear of missing out. Like I talked about earlier with the example of the squid token, FOMO led people to rush in and buy this squid token thinking that they were going to have amazing returns. So you're buying based on hype. You're not doing the due diligence that's required of traditional investing. You're also panic selling during drops. And smart investors are always going to stay calm and be prepared and invest with the future in mind. So key takeaways when it comes to navigating the risks of crypto is you want to be safe. Use trusted wallets and exchanges. Never, ever, ever share your private keys. If you lose your private keys, you will lose your tokens. There's a common phrase in crypto, not your keys, not your coins. So that's something you always want to safeguard. And you, of course, want to research before doing any kind of investing. So here are some resource activities for teachers who are doing this in a classroom, or again, if you're a parent who's homeschooling children, you can look through these activities and think about ones that might engage your students. We'll see you in the final module, Module 5.